It's interesting listening to investment professionals because you assume a lot of knowledge that isn't there.
Yeah.
So you're in the top percentile. What does that mean?
Well, it means that of the whatever 1,000, let's say there were 100 funds, we'd be the top fund. Now, we're not necessarily the top fund because there are not 100 funds. If there are 1,000 funds, you're in the top 10.
So it's the top 1%.
Of that peer, I think there was 1,600 funds. So they're the funds that, Morningstar say a large cap blend equity. So you will find many of the large competitors that people compare us to in there. And if you look at the value, if you narrow it down and say, well, what about just the value guys? It's pretty similar.
But that's brilliant. So well done, Sean. I mean, top 1% in the world, it deserves a round of applause. However, I've only ever interviewed one other person who's been in the top 1%.
I know who you're going to say.
And he's no longer in the top 1%. So isn't that the problem?
So that is the problem?
You've been winning a lot of races, but to keep winning.
Yeah, Alec, and I think that is right. And if you'd looked at midway through 2020, we wouldn't have been in the top 1%. Okay, we're only in top 1% because we stuck to our guns. We said that this doesn't make sense. We are not going to participate in Tesla and Peloton and Zoom and all of that. It doesn't make financial sense. And people say, but you're underperforming the benchmark. And I go, well, you're doing more crazy than the benchmark. Okay, so we're going to just invest. I mean, that 1% is incident. It's not our focus. I mean, our focus is just doing sensible things with people's savings. And wherever that we end up, well, that's where we end up. But you can't chase 1%. That's just the result. And I think the pressure, from a value perspective, the pressure to change was enormous. I mean, if I'd been at anywhere other than maybe in Investec with, John Bacard, I would have been fired. No doubt about it. Because if you underperformed for 3 years, you're out, you're done. And so that is what the pressure is on normal fund managers. But we've seen through it and the wind has shifted. Microsoft, I'd be surprised if Microsoft growth starts accelerating. We saw Hewlett-Packard come out with results 2 days ago, and I think revenue was down 19%. So things are always changing. It's a ever-moving world. And so, buy and hold. We saw Warren Buffett or Berkshire Hathaway, they sold Taiwan Semiconductor. Well, I guess they've taken a view that the Chinese risk is not worth having, and so they're going to act. And so we like that. I spend every waking moment, and most of my sleeping moments too, thinking about the portfolio. Is this right? Have I got too much there? Is the risk there? All that sort of stuff.
And you're not kidding, because we played in the same 4-ball on the golf yesterday. When the rain came down, a normal person would have said, well, maybe we should be going back to the clubhouse. Sean shouted from the cart behind, time for a stop loss. Size is an anchor to growth. Another Warren Buffett story. He says that if he was as small as he was 50 years ago, he'd be able to continue making 30-40% a year. That is is something that he says. It's something that the stats bear out, but it's not something that the public seems to appreciate.
Well, I think that, I think you're 100% right. Maybe the public do appreciate it, but remember that between that and the investor, you've got the advisor. And the advisor has got something else. They're not all independently minded. And they've got something else that once they've got the client's money, they don't want to lose it. And if they take a bet on Ranmore, and Ranmore has a bad 2 years, well, then they're going to look bad because, well, who the hell's Ranmore? Why'd you put my money with those guys? Whereas if they invest with one of the large names and they have 2 bad years, well, the client's not going to shout at them because it's the large guys. We all know them. So that is one of the problems. And I think, I would just encourage people to liberate your advisors. Say, well, if you're only going to give me the names of the big companies, I know those guys. I don't need to pay an advice fee. I could do it myself. But go find me these boutiques who are going to outperform, because that's when you're really adding value.
It sounds a bit like when I did national service and they were chasing us around the parade ground. You wanted to be in the middle of the pack, never in front and never behind. Is that the philosophy?
I think that's the case. And as a fund manager, if you buy Procter & Gamble and Microsoft and Google and the fund does badly, these wonderful companies. If you buy Sanmina and Sanmina, has a bad, it's like, what the hell are you buying Sanmina for? Who's ever heard of that thing? So, but we're just going to tell people what we do, and we only want investors who agree with how we manage money and they think it makes sense. And we're going to go and find those undiscovered jewels and wait until they become jewels. And if they don't become jewels and we suddenly find out actually this is a piece of rock, not a diamond, well, we want to be able to exit. And we can exit because we're not stuck in something that doesn't move.
You said that to me the other day in a conversation we had, that you are an active fund manager.
Yeah.
Active meaning that you do sell shares and you do exit, not always when they're at a high price, but when circumstances change. Just talk us through that and how often you might trade in your portfolio.
Well, look, the way I think about it is, if you're a top barrister, you're not going to win every case. If you are a top golfer, you're going to hit balls in the water. If you're a top tenor, and I did yesterday, I'm not a top golfer. So,
yeah, if you're not a top golfer, you're going to hit many balls in the water. Yeah.
But what did Tiger Woods used to do? Take the ball, I take a drop, and he put that behind him and move forward. And I think there's an expectation that fund managers are going to get every position right, and we're not. And if you think that they are, then they're misleading you, but they're not. If you get 7 out of 10 right, and you don't lose too much in the 3 you get wrong, you are going to shoot the lights out. Okay, but you just got to and that's what I like about the value philosophy and why I believe so strongly in it, because lots of companies I get wrong. Okay, but if you buy them at an attractive price and you decide, okay, well, I got this one wrong, you're not going to lose too much. If you buy Tesla and you're wrong, you're going to lose. And it goes to size valuation, you're going to lose 80% of your money. And that's the difference.
You also talked to me about Irish banks, and I never had the courage to add it into the BizNews portfolio. Is it still an opportunity now to do that?
We've taken our profits in the Irish banks. Okay,
this is what I asked.
Yeah. And there's Europe. We haven't reduced our weighting to European banks because I think European banks are a great place to be. We talked about Europe. We talked about the funding of solar here, and that's that benefits the banks. Well, in Europe's trying to make sure that they don't have to rely on Chinese manufacturing. So the factories that are going up in Europe are extensive, but also interest rates. These poor banks have been operating, because people will tell you banks are horrible businesses, but some of the, as the late Simon Murray used to say, some of the oldest businesses in the world are banks. They can't be terrible. Not all of them can be terrible. They can be badly managed, but the idea still works. And these poor European banks have, for many years since the European crisis, had to, try and make a buck with interest rates down at naught and negative. And so they cut costs and cut branches and, all of that. And everyone said, but these American banks are so much better. But they weren't. They're just American bank interest rates weren't quite as negative as European. And now what's happened, so they've got all lean, and then the pandemic happens, and so they couldn't buy back stock and they couldn't pay dividends. Now interest rates have gone up. So now interest rates are rising, and so conditions are improving for these banks, and they're still at half book value. And so so now in our top 10, we doubled our money, we more than doubled our money on AIB. But you can imagine the response that I initially got when I mentioned Irish Bank. People go, oof, it's terrible. What are you doing owning that? And you go, well, Ireland's economy is doing well. And it's the only English-speaking country, or primarily English-speaking country in the European Union after UK exited. You've got the tech companies there who are paying profits or tax on the profits from the pandemic, so the government's fiscal, situation is good. And you've got these banks at, 30%, 30 cents on the dollar. One of our largest positions now, Santander, which has done really well. So we like to switch. We like to say, well, hang on, I pretend that my cat has walked across the keyboard. So, all of a sudden, look at my top 10, I go, well, I got a 4% position in AIB because it was 2, it's doubled. Would I buy a 4% position in AIB today? No. Okay, what would I buy today? 1? All right, let's take some profits. And that's how I think. We go, well, but what about Santander? They're exposed to the similar sort of factors. Spain is miles away from Germany. Spain's solar energy is less of an issue. Got some exposure to South America. South America seems to be doing okay because of commodities. But Santander is much cheaper. Great, let's take some of that 3% off the table and put it in Santander. So I'm doing that all the time.
So that's what an active manager does.
And what I do is I've got a target price, and I know for each stock, not we. And so we've got a portfolio expected return. If everything traded at our target price today, what would our return be? Okay. And I'm always trying to get that number higher. So I'm saying, well, we can only make 3% on this thing, but we can make 18% or 28% on this thing. Right, let's take some money off that and put it there. Now, you don't get it right all the time, but that's my objective. I'm trying to keep that target price potential return right up there.
And that's what gets you into the top 1%. Course Civic, please don't tell me you've sold it. It's still in our portfolio.
No, we've taken some profits. I mean, it rallied hard when everything else fell. So the relative, it relatively outperformed massively. And so I like to take profits. But we still got a position.
You still got it. So we could keep it in our portfolio. Because I know there are a lot of people here who are following our model portfolio, which is based on what our informal
It's one
governance
tweak.
tell us.
It's one tweak. But we've still got, I think, about 1.8% position.
So it's one twig. Is there another twig that you can give us that we can add now?
Well, I mean, as my previous speakers have said, and they're right, we don't give advice. And so I would hate for anybody to cash in pensions and go and buy one of these stocks. So I can just tell you what I've got. And then if it fits with your story, great. But Sanmina is a good company. And I think this onshoring is going to be a trend to continue. And what I like to look at, I read a lot of conference calls, okay, because it tells me what's going on, even companies that no interest whatsoever in. And I mean, you read the Walmart conference call. So I mentioned Walmart and Massmart here just earlier. Which part of Walmart is doing well? It's grocery. Well, we've got grocery retailers in the portfolio. I've been buying those because I think they're great and they're stable. And of course, when this tech rallied in the first couple of months of the year, no one wanted consumer staples. And I would say, well, why would you own a Procter & Gamble, which has only grown earnings 4% compounded for the last 10 years? Why would I buy that on 26 times earnings? Why would I buy Walmart on 33 times earnings when I can go buy food retailers on 10? And who controls the route to market? Because Procter & Gamble are going to phone Kroger or Albertsons or Massmart and be really nice and say, can I sneak through that price increase? The retailers are saying no. And private label, I'm actually writing a piece for LinkedIn, private label is taking over. Brand values for consumer goods, I think, are done. And, I don't know what shampoo you use. Okay, Louis Vuitton, it's a bit different, but no one walks down the street knowing what dishwashing liquid I use, as long as my dishwashers come out clean. And the food retailers benefit enormously. They make much higher margins from private labels. And remember those private label, Alec, just in the years gone by, Pick and Pay, I don't know what it's like in South Africa now, but it was the blue stripes and it was the Pick and Pay baked beans. Okay. Now what they've done is they've got a range. So you've got your Waitrose Essential, you've got your Sainsbury's Taste the Difference, you've got your Asda Extra Special. But I went into Asda the other day and you could buy Sensodyne toothpaste, £4 a tube, Asda Sensitive for £1 a tube. Now if times get tough, I think people are going to try the Asda Sensitive.
I had a wonderful chat with one of the beauties of living in Hermanus is there are people from Swallows who come out from Europe and very, very senior, often very senior executives. And this guy is a very senior guy in the oil industry.
Yeah.
And he said the problem they've always had is it's impossible to differentiate petrol. He said the only company that got it right was Esso with a tiger in your tank. Somehow that worked. But generally speaking, a lot of the products are heavily marketed so that the differentials are shown to us. So is that really what you're telling us now, that maybe the Pick and Pay baked beans is not a hell of a lot worse than the Woolies baked beans if they've got one, and perhaps better than the ShopRite baked beans, etc., as a private label?
I think so. And I think when they first launched, they were inferior in quality, many of these private label things. But I think that the supermarkets have figured out that they make way more in gross margin from those. And they're pushing them. And in some retailers internationally, Carrefour has got 33% of their sales now are private label, and they're moving to 40. Now, why would you move to 40 if you're making less money? And yeah, so I think it's a real thing. And at the end of the day, as we progress, more and more things become commoditized.
While we get the questions, if you can get the microphones, in a South African context, then that's not good news for Tiger Brands.
I mean, I don't know Tiger Brands. It's it depends on what their competitors are. So it's not going to be all brands. As I said, Louis Vuitton will make a difference, and there'll be certain products. Interestingly, I will buy Waitrose dishwashing liquid or rinse aid. I won't buy Waitrose beer. So not all the products are the same. And there'll be certain categories. People won't buy no-name Coke unless you're going to mix it with brandy or something. But it will, it's not everything.
Or no-name whiskey unless you're going to be putting cream soda in it.
Yeah, and so what we try and do is we're trying to find in an ever-changing world where are the opportunities. Well, if times are tough, people are going to be trading down. Well, who benefits from that trading down? Private label. Okay, well, who are the private label manufacturers? Well, there's one or two, but they're quite expensive. Well, what about another way of playing it is retailers? And that's how you end up there.
Okay. Lovely. Mind exploring. Okay, well, we've got Carmen at the back with a microphone. We've got Stuart. Okay, Stuart.
How's it, Sean? Great you're on. So we listened to Sai and we listened to Peche regarding opportunities in the South African market. So we spoke about blind spots. So one of the question really is, you run a global equity fund where you can invest anywhere in the world, including South Africa. So how much exposure do you and your fund have to South African stocks? And then also, what would you take a binomial bet on an election to actually invest into a South African stock? And what would be the maximum exposure to a South African stock within your portfolio? Sorry, that's the first question. If I may just have another one.
If it's as good as that one, you can have 10.
So the other question is, I'm looking, Sean, your fact sheets on your website. So you can go, everyone can go look at the website. You spoke about first percentile performance. If you look on your fact sheet, over 10 years, you are a first quartile performer, but you've underperformed the MSCI World by 40 basis points. That means 75% of your competitors have underperformed the market by more than 40 basis points. Now, this is the reason why people's moving to passives. So my question really is, shouldn't you change your fee structure? Because you were dead against performance fees, but shouldn't asset managers rather charge a fee based on the value add that they're generating? Because how do you make fees? And asset management's a very lucrative business. How do you charge 1%, 1.5% in fees if managers underperform the benchmark? Why don't you charge a passive fee? But if you outperform, then someone pays you. Because then you're being paid for value add. And that's how services work. You need to be paid for value add. 2 questions. Thank you.
Dankie.
Yeah, very good questions, Gregor. I mean, we only have a 1% position to a company in South Africa, and that is Thungela, and we did very well on Thungela on the way up, and have been nibbling after the substantial pullback. And I guess we do have the luxury of looking around the world, and I can go buy Spar, I can buy Carrefour, I can buy Kroger, I can buy Albertsons, but I'm not going to buy a Japanese food retailer because they're expensive. So I can go buy the European food retailer, and I can buy the American food retailer because that's attractively priced. And I can buy the European car manufacturer, and I can buy the South African coal miner. And so that is the luxury that we have. We can cherry pick, like, the tech companies in Japan might be cheaper or whatever. And I mean, you would have seen, if you had a look there, Petrobras. There's our largest holding. And Petrobras released results last night. Now, I was too busy getting the presentation ready so that I didn't get into trouble with Danita to read the results in detail early this morning. But the biggest fear people had is they said, well, Lulu's going to come back in and he's going to mess things up and all the rest. And we said, well, hang on, this makes the same free cash flow as Chevron. But Chevron's market cap's 300 billion and Petrobras's market cap's 65 billion. And they're going to cut the dividend, they're going to invest in wind, and they go, well, it's a windy place, it's not a bad idea. And so my upside was 5 times if this political risk goes away, maybe not 5, maybe 4 times. My downside is, well, they've got minimal debt these days. And I don't think they're going to do stupid things, and they're going to learn from the mistakes of others. And maybe they pay a little bit of a dividend. Well, they just paid a dividend. They announced a dividend. They got the new CEO in place. They announced the dividend for the latest quarter, which is a 10% dividend yield on one quarter's cash flow. And there was a very positive comment after that. So sometimes it wasn't a binomial outcome, because I didn't think we'd lose. And if they started making terrible noises, well, I could sell. I'm going to take my 10% loss or whatever it is. So we have that luxury, and I mean, there are some, the South African banks sound attractive, but Santander is on 6 times earnings. And so why do I need to take, I can buy a 6 times earnings company in South Africa or Santander. And Santander will be more liquid, and I don't have to worry about the currency as much. So that, I think, is a factor. Now, you could argue that, that the South African companies make a higher return on equity than Santander. Yeah, but I think Santander's, we're working off a lower base, etc. So, I think I have the luxury of being an international investor, and I can choose to invest wherever. And, would I buy Sasol? No ways. Okay. Petrobras over Sasol every day of the week. Because the Brazilian government has 50% of Petrobras. So they have an incentive in making sure this business is profitable. The South African government does not own 50% in Sasol. And actually, who knows? You could wake up tomorrow and the basic fuel price levy formula has changed. So I don't know if that answers the first question.
Yeah, that's fair comment, 1%. The other part of the question, though, how you're incentivized.
Yeah.
And it sounds like a pretty good formula where you compete on a cost basis with passives, but then you participate in outperformance.
Look, asset management is very lucrative, but not if you're a tiny boutique like we are. I mean, hopefully at one point it will be lucrative, and what we've publicly said in our prospectus has just been revised up. As we grow, our fees are coming down. I mean, we've said that. There's a sliding scale in the prospectus, which is, with the central bank at the moment. So we're trying to do that. I mean, the argument I would say is, there's a thing called active share that I think everybody should look at. How different are you from the index? If you have low active share, in other words, you're very similar to the index, invest in a passive. Okay? And if you have high active share, well, I'm offering something different. So if I'm offering something different, well, then why must investors pay the rate of the passive? Now, the problem is, in theory, it's great. Well, yeah, but Sean, you charge performance fees. Okay, but over what period and what's the mechanism? And as I'll try to outline, they're very complex things. Do you have, if you're a daily dealing fund like we are, do you have a new series for every investor every day? Do you know, in other words, because if you invest today and it goes up, well, your high watermark's different to the guy who invested yesterday. And so you've got to have a new mechanism. It can get really, really complex from an administrator. And that's why many hedge funds only deal monthly, so that you have a different series for each month. And then when they all hit high watermark, they all convert, etc. So, all we're going to do is charge a fair fee. I mean, if I charged a performance fee based on my peers, have a look at that. I think with the peer benchmark, it would have been at 5% last year, and we didn't. So I just want to charge a fair fee, and we're not getting rich, I can promise you. And when we do, it's all going to go back to, we've said 25% of our revenue is going to go to charitable causes that our clients are going to choose. But if people, that's
as long as you've got a set of drums that you can bash away at, you're happy.
in silence,